Hi, how are you? Well, welcome back. It's Mark Fielding Pritchard here again from ME Fieldings. And I think, as I said last time, that we just need now to finish up with our inventory. So this is the last little section. There's kind of three separate topics to cover here in this last presentation, number 4. They are the impact of write-downs. So in what circumstances do we write down our inventory? Then we'll look at model notes from the financial statements. So whether you're producing IFRS statements, whether you're producing IPSAS statements, what do you actual notes that go in the accounts look like? And then finally, we will look at dealing with the auditors. The auditing of inventory for commercial and non-commercial organisations is a fairly big topic. So we'll just look at some of the common comments that are made by government auditors, be they from supreme audit bodies or be they from big four accountancy firms, wherever. Once again, thank you very much for tuning in to this. Please can you like us on Facebook? If you have any questions, please come onto the website. Have a poke around the website. There's some stuff on there. In terms of future projects, we're probably going to be looking soon at the RPGs. RPGs are recommended practice guidance for IPSAS. So the IPSAS board has now begun issuing these opposed to standards. Right, that's slide number 1. I'm Mark. Thank you for listening. Let's press on. Okay, slide number 2. It does have a number on it. There it is, slide number 2. Right, so slide number 2, as you can all read as well as I can, is impairment of inventories. This happens in the situation when you have in your books and records inventory. So in your financial statements, you've got usually opening inventory. That opening inventory obviously has a value. If it's for sale, it will be the lower of cost or realisable value. If it's not for sale, then it will be the lower of cost or replacement cost. And that value is too high for some reason. Now, where I used to see this all the time, because I used to own my own training company, was where we had in the warehouse textbooks. You start getting things like textbooks that are 4 or 5 years old. You've got them in your books and records as stock. What are you going to do with it? Well, you can't sell 5-year-old textbooks, so therefore you have to get rid of the books physically, and when you get rid of them physically, you have to write them down in your accounts. So you have an expense in your accounts. So you'll credit, reduce the value of your opening stock, and you'll debit some expense somewhere else down in your expense accounts for your stock write-off. Right, when is it necessary? Well, if there's damage or spoilage, and once again, most of these here actually relate to either government organisations or commercial organisations. So damage or spoilage, with the weather that we've been having in the last couple of years, especially here in America, foodstuffs spoiled by floodwaters, spare parts damaged by fire, and so on and so forth. So anything which is damaged or ruined because usually of some kind of natural circumstances. You may find that you have insurance, so therefore obviously you'll set the insurance against that. So that your debit, cash and credit income, which is the insurance to cover you the cost of this. But foodstuffs spoiled by floodwaters, spare parts damaged by fire, and this you'll take out the value out of your books and records. Obsolescence is where items go past their sell-by date. So if you have food, it goes past its sell-by date. So therefore you can't sell anymore for a supermarket. So the examples here that will be taken from somebody like the UN, vaccines or rations past their expiration date. So vaccines, in the same way as food, has an expiration date, and IT spare parts. Can't say I'm really sure what IT spare parts are, but this could be the kind of thing where you've purchased Microsoft Word discs, and now it's Word 2003, and you're obviously up to 2010 or whatever, and those things are actually just no longer compatible. So we get IT parts where there's discs with updates and upgrades on it, and you can't use them because they're no longer compatible with your ERP. Theft or loss, spare parts that, nicely as it puts here, disappear from a warehouse, or a warehouse looted during a civil disturbance. Sadly, it happens all the time, but you have some inventory, some stock of goods, and some of those goods disappear. Certainly having had clients in the past who are things like cigarette factories, stock of cigarettes have a tendency to walk. Warehouses looted during civil disturbances. I guess that certainly happens to people like the United Nations. And the fourth one is overpricing. Right, overpricing here just simply means that the value is too high. So we have goods where the market sale price is now less than the cost. So the value has fallen, whether it's due to devaluations of currency, whether it's due to the fact that people just actually don't want what you've produced. If you come back to certain things like airlines, they'll change their uniforms periodically. So the old uniforms, again, will have to be disposed of. And that will be overpricing because they have no value at all. So they'll be written off. Okay, that's impairment of inventories. You'll debit some expense account and you'll credit the value of your inventory in your balance sheet, in your statement of financial position. And those are good headings there, but it's a situation where the inventory becomes worth less than the value that it's recognised at in the balance sheet. Right, this slide is actually very easy and very, very obvious as long as you understand what it is that we're doing. What we've got here, therefore, is we have model notes for the financial statements. So I guess probably my slide would have been better if I'd included a heading which says inventory as well. But this is an actual note from financial statements. From memory, I think it comes from the World Food Organization. And so therefore all you have to do is read it, and that's an example of what you can actually use. So if you are working in a government somewhere and you're thinking, gosh, what should it look like? You can actually cut and paste this as an example. So it says their inventory is held for distribution at no nominal charge, valued at lower of cost and current replacement cost. So this is clearly an organisation which is a non-for-profit or a government, not commercial yet. Inventories held for sale are valued at the lower of cost or net realisable value. Certainly many government agencies will have certain items of inventory or stock which they are selling and certain which are there for distribution. So absolutely very common in non-commercial organisations to have different policies for different types of inventory. Cost to purchase inventories which are interchangeable is determined using the FIFO method. You can see there's a nice comma there for no reason. There's no reason why that isn't LIFO or that isn't weighted average. It probably shouldn't be LIFO, but again, they've chosen to use FIFO. And transportation costs for aid inventories distributed are capitalised up to entry into the recipient country. Right, so please notice what they're doing there with transportation costs. If you remember that the cost of your inventory should reflect the cost of bringing it to you and making it usable. Now they're actually saying that transportation costs stop at the border of this country. Now I have to tell you, I don't actually know why they've made that decision and why onward transportation to local warehouses is not included. For whatever reason, they have decided that under IPSAS that in-country is not part of making the product usable and is not necessary. I'm assuming that has been agreed with their auditors, so they have a valid reason for that. Right, I hope that's clear on that slide. As I said, I think it's, as long as you understand that all that is the first part of the note from the financial statements, and we've just cut and pasted it from an organisation, that's very, very straightforward. With all of this stuff, if you have any questions, send me a question. Best way to do it, send it through the website. So a couple of things here. They're telling you that write-downs from cost to current replacement cost or net realisable value are recognised in the statement of financial performance. Now, that's a nice little note actually, because what it's telling you therefore is that when you first acquire inventory, you always include it at cost. And then having been included at cost, what they then do is they then do a check to say if it's for resale, is the net realisable value, including all of your taxes and so on, less. If it's not for resale, if it's for distribution, because they're uniforms or something, then we're saying that the current replacement cost is less than the cost, and then they make this write down afterwards. Therefore, the figures which are included in your statement of financial position, your balance sheet, are after the write downs. I hope you're quite clear on that. Right, and then it just gives you a nice little breakdown for a standard manufacturing company. So they're obviously manufacturing something here. You can see therefore that they've got raw materials, work in progress and finished goods. So, you know, if they're manufacturing, a company I did some work for was Nissan. So therefore, raw materials is your raw materials of metal and so on, which is sitting in your warehouse. Work in progress is those items which are part completed. So they'll have a policy as to what that actually contains. But certainly as a minimum, it contains the motor cars at the end of the period, which are in some stage of construction but are not completed. And then your finished goods is your stock of completed cars that are actually sitting waiting to be sold. And you can see there that you've got your raw materials, finished goods, work in progress. Remember that your work in progress and your finished goods will include not only materials, but will also include labour which has been spent on those items and direct production overhead as well. So that's your raw materials, work in progress and finished goods. And that's what you'd expect to see in an organisation that has some kind of manufacturing capacity. In addition to that, there are other sundry inventories. You would need to see what they were actually including here, but certainly other sundry inventories would often include, who knows, it's stuff which isn't direct for the manufacturing process. So there might be some indirect materials, so materials that the maintenance department use. They might keep some other kind of spare parts. So if it's a motor car manufacturer, they might have spare parts of windscreen washers and so on, which would be spare parts that they would sell to dealerships to repair the cars. Other kind of things which might be in there, it's non-production stuff. So you might find that even things like paper for the offices and so on go through that account. You'd have to have a look. But certainly inventories of items which are non-production items. And as I said, if it's a car manufacturing, it would be things like things that are specifically for spare parts, windscreen wiper blades, who knows, screws, the mats for the floors, spare parts as well. They probably keep spare clutches and things like that, if I remember it. Right, that's your note. Have a look at your note. I think certainly the first part's quite nice. The second part is quite straightforward, as long as you get in your mind some clarity on what it is that you're actually reading. It's a model note that goes into the financial statements, and it follows on from slide number 3, which is the one before. Right, as you can see, this is slide number 5, and these are model notes of financial statements. Right, once again, I think this is very straightforward as long as you get clear in your mind what it is that you're reading. Please can you notice that this is a different organisation from the organisation that we had in slide number 4. So it's a different organisation. Secondly, just look at the information that's contained here. Right, the first part of the slide tells you that the total year-end carrying amount of inventories includes 2 million in donated inventories carried at fair value. Right, so what they're telling you therefore is that this organisation, which is different from the one in slide number 4, has $2 million of inventories which it received for nothing. So those inventories were donated to it. So it could be food donated by some, who knows, Allied Lions have donated to the World Food Organization 2 million in inventories. Right, remember that when that comes in, therefore, they will debit inventories and credit revenue because that is a donation of $2 million. And it's carried here at fair value. So therefore, the fair value of that donation is 2 million. In real life, for organizations like United Nations and NATO, that will be very important because the company that's given them that food presumably wants the world to know it's given that food. So it will tell you what that value is. And obviously you'll dispute if it's wildly overstated, but that would be unusual. Right, that's the first part, that we have this 2 million in donated inventories and that we've actually highlighted that. Right, the second part, so where the green triangles are, expenses related to inventories and down. Right, this is an analysis of what's gone through your income statement, so what's gone through your statement of financial performance. So included in our expenses are in that statement, in that financial performance, statement of financial performance, is expenses that are related to inventories. So once again, we saw them before, transportation costs, for example. Now these are things that have gone. This is stuff that's gone, because we're now on to what in the good old days when I was still young used to be called the income statement or the profit and loss account. So these are expenses that have gone through. Expenses that are related to inventories in that statement amount to $700,000. Okay, Cost of merchandise sold. Right, this is telling you that we purchased items for $300,000. So we purchased these goods, and then subsequently those goods were sold. They may have been sold for $300,000. They may have been sold for more. In other words, they may have been sold with no view to profit. They may have been sold with a view to profit. You can't tell that from the note. But the cost of items which were subsequently sold was $300,000. The cost of supplies and consumables used. Right, this is items that they've purchased themselves and have used themselves. Now, once again, to drag you away from the United Nations or from NATO or World Bank, wherever, and to put you back into a commercial setting, just think about somebody like Nissan. Nissan manufactures cars and it sells the vast bulk of those cars. But the people who work at Nissan, some of those people will want to buy cars. It doesn't make a huge amount of sense to pay somebody $30,000-40,000 to have them walk around the corner and spend that money in a car dealership, particularly as, you know, economically you can provide that car for a much lower cost. So therefore Nissan will take a certain proportion of their cars, a certain number of their cars, and they will give them to people who work for Nissan. Now that's what you're seeing here. Certain items have been purchased which we would normally expect to be, we're going to flip back to the United Nations now, certain items have been purchased which we would normally expect to be donated, distributed, sold, but in fact they haven't been. The companies used them themselves. Who knows what this is? If it's the World Food Organization, it could be that they have their headquarters in Rome. Maybe they have a big canteen in Rome that provides free food to people who work there. So the World Food Organization is taking food and giving it to its people for nothing. As part of their salary package, they get a free canteen. That's a fairly common one. It could be that, who knows, you know, that what part of their big deal is that they run training courses, and on the training courses they give people pens and paper. But here it's pens and paper that they've purchased, it's gone through that account, but they've used it themselves. So this is items that your agency has used itself rather than distributing and giving away. Right, the actual cost of inventories distributing, the actual cost of inventories distributed is $500,000. So I have to say it'd be a bit disappointing if the World Food Organization was spending 4/9 of its income on itself for food, but there you go. So cost of inventories distributing 500,000, and remember we're looking at expenses. Here you've got an inventory write down. So for whatever reason they've got some inventory in their balance sheet and they've written that value down for 200,000. Whether it's been stolen, whether it's been damaged, whether the value's gone down. Right, once again, very important that you understand what it is that you're looking at there. You're looking at disclosure items in a note to the financial statements. The note relates to inventory, but it's items which are in the income statement. Okay, hope that's clear. Final step in our process, therefore, is looking at typical audit findings. Inventory, the first thing that auditors will always look at is fixed assets, is your property, plant and equipment, because it's the easy one and it gives them a feeling as to how well organised your company or your agency or your ministry is. After that, it's usually inventory. Inventory, again, is because for auditors it's relatively simple to look at. It's much easier to go and count your inventory than it is to sit trying to work backwards through purchase orders or whatever to make sure that things have been correctly signed. Typical audit findings, you know, and usually when we write typical audit findings, we're looking at the point when an organisation or a ministry or government is adopting IPSAs, because usually they've had some historic basis of recording stock, of recording their inventory, and now they're trying to bring that in line. And IPSAs is a very, very powerful and useful tool for identifying weaknesses in systems, and usually inventory is a system that has lots of weaknesses in it, because your inventory system was designed 100 years ago. No one's ever changed it since then. So the kind of things that they come up with, and no reflection on any organisation I've ever worked with, ever, not even a bit of course, would be valuation, inventories not being recorded at an appropriate carrying value. This is a big one. Particularly when you have manufacturing industries, the big question is, what do you include and what do you not include when you're trying to include raw materials, labour and overheads and so on. So you need to come up with a skeleton calculation for that and then get that agreed with the auditors and then look at the value and does it give you a reasonable value. If you worked for somebody like a fashion shop, a shop that sells fashion clothes, certainly you would normally value your stock at sales price minus some fixed markup, and so that's quite easy. But if you're manufacturing, or God forbid if you're a building company, so you're valuing half-built buildings, what do you use? It's all in the method. Get the method right and then you just stick the numbers onto the method. Completeness, incomplete inventory records. Again, once your system's up and running, this shouldn't happen, but at that moment of conversion, you do have to make sure that everything is included. And even in private industry, you get people who just about to sign off on their accounts and they've found some more stock or whatever, as they think the profit's too low. So make sure that you've got all of your inventory in there, and that's particularly important with a correct classification of what is inventory and what's not as well. So you have to get your definitions and your policies up front right and then apply them. And again, if you're in the World Bank or something, God only knows what you've got all over the world. Existence, it says here reporting assets, so it kind of goes with completeness. It's just the opposite. This is when you start recording inventory, because you're sitting in an office in Geneva or New York or somewhere, and it says on the screen that they've got this stuff. So you're going to fly to Burkina Faso to check it. And then, of course, the auditors do go to Burkina Faso and they find that the stuff isn't there and hasn't been there for 25 years. It's the opposite of completeness, isn't it? When you're overstating your inventory rather than understating. Very, very important that you get it right, because otherwise your management accounting system is going to be out of kilter forever. Rights and obligations. You have to understand what inventory is yours and what belongs to other people. The big ones that we had, I love talking about motor cars, as you can see. We talked about consignment stock, what's yours and what's not yours. And this is something as well, something that belongs technically under an agreement to the World Bank, but NATO has access to it. Do you have control or do you not have control? And NATO probably has guns, so they can say they do have control. But you need to make sure that your inventory is appearing in the right organisation's books and records as well. And that's a big one. A number of times you end up having 5-day discussions on what constitutes control. Some organisations want everything in their balance sheet, make them look as big as possible, and others want to lose everything. Let's just keep it nice and lean and thin. Makes it look like we're performing very well then. Rights and obligations. Finally, presentation and disclosure. Presentation and disclosure, is when you're setting things like thresholds. At what point does something become part of inventory? If you have 2 million screws and they each cost 0.10 of a cent each, are you going to show that? Are you not going to show it? And you have to be consistent as well. Again, one of the biggest problems with IPSA's implementation is this idea that the Ministry of Finance, we don't have anything, we don't want to show it. But Ministry of Defence, my God, we have 25 billion screws, so we have to show them. And then how do you actually get them to agree with each other? Particularly when you get in some countries where the Ministry of Finance is in a different city from the Ministry of Defence, and these guys never meet each other, And then suddenly the army realise that it's actually important because it affects how much money is left in the budget for their salaries. Suddenly accountancy becomes, I dread to use the word sexy, but certainly gets to the top of people's to-do lists. Right. Just be careful. You all know now your basic concepts, so your consistency and so on and so forth. But this is very, very typical audit findings but at the point of implementation. If you have a good organisation and there is some commitment to get it right, once you're 2-3 years down the line, you shouldn't be getting this stuff. If you are, you need to kind of take it by the scruff of the neck. Okay, right, that's the end of inventory. I said when I think we did in some weird order, like inventory 2 we did first. People were buying inventory 1 at that stage. You have your 4 sets now. If you have any questions at all on inventory, and it's very difficult to do, big topic in real life, give us a call. You know where the website is. You know, most of our advice, like these training courses, are free now. As somebody once said with the internet now, you give the house away but you sell the backyard. That's how you make your money on the internet. Right, if you enjoyed it, like us on Facebook, subscribe. We've got a lot more stuff coming. If you're into IPSAs, there's going to be RPG 1, RPG 2, Exposure Draft 53, which is first time adoption. If you're doing ACCA and stuff, have a look at this stuff anyway. Hey, you never know. And United Nations is always hiring people. You can use it in an interview. Thanks for your time, guys. Thank you very much. Bye-bye now.